My next guest calls this a runaway bull market and has some names he says are now poised for a breakout. Joining me is Brian Reynolds, the chief market strategist at Reynolds Strategy. Brian, it's always good to have you on. Let's, I guess, start with the actionable piece of this, which is what names to you scream buys here?
Well, I did a two-part screen, one for technical breakout potential, and then another screen looking at how the credit of those companies trade. If there's a drawdown, would the credit market support debt-fueled buybacks? And my initial screen had 256 candidates on Friday morning.
Wow.
After Friday's rally, that number grew to 307 names in the Russell 1000. So that's almost a third of the Russell 1000 that's poised for some type of breakout. I don't know when that's going to be. I think it's going to be in the last third of this year. But we know that once they get above their old highs, they tend to attract momentum investors. And with the credit market having put wind in their sails, I think a big chunk of this market is poised to go higher later this year.
You know, the market's reverting back to what we talked about for years going into the pandemic, which is a market where you have intense buybacks, you have very low credit yields, and that translates into high equity prices. And even though at first we thought that debt might be more of a hangover, it feels like companies have quickly moved past the debt buyback phase and are now back into the stock buyback phase. So your point is you almost don't even need to name them one by one. It's basically swaths of the market this applies to now.
When I was on with you in April, there were 177 companies in the S&P who were buying their stock back. Now that's up to 215. And I said back then, it's probably by the end of summer, we'll see a majority of companies buy their stock back. And we're on pace to do that. And that's one of the criteria for what I call a runaway bull market. There's actually 10 technical criteria. This bull market meets 8.5 of them. And that's the same thing I saw in 2014 when the S&P 500 was at 1,800.
It's crazy to think we could have another 5 years of this. But again, we're always, subject to the tyranny of now. After you've been doing this for 10 or 15 years, you realize every year there are people who aren't thinking about the fact that it's been 100 plus years of a stock market and that it finds ways to generate returns throughout all of those periods. So my point being, you think this equity bull market can persist whether bond yields go up or down. Explain that.
When bond yields go up, credit funds have losses on their bonds. They're not hired to make losses for the pensions, which are the big driver of these credit cycles. So they invest more aggressively at the new higher yields to paper over their losses. And when yields go down, the new money that's pouring into pensions and into the credit market has to be invested more aggressively to make their above market bogeys. So actually rate or yield volatility is actually good for a credit boom. Whereas in February, yields were going up. Equity investors were concerned about that. Now yields are going down and equity investors are concerned about that. Both of those moves, though, make a credit boom more intense. And now you've got retail powering the stock market with stock buybacks as a backup. So if retail stops buying the dip, companies are building immense war chests through the credit market with which they can buy back their stock on any pullback.
Shepard Smith here. Thanks for watching CNBC on YouTube.